part 5. If you've made it this far, congrats. If this is the first video you're seeing of this entire series, then I recommend you go back to the intro or back to part 1, so that way you haven't missed anything yet. But if you've made it this far, congratulations. In today's video, we're going to talk about the 5th technical tool you should never be solely using in your Forex trading, and that tool is the Fibonacci. This may make a lot of traders mad because they live, breathe, sleep, and die by the Fibonaccis and the fib and the fib retracements. But in today's video, I'm going to be covering exactly why you shouldn't be using it. Before I get into that, though, if you don't know what Fibonacci is, you can type in Fibonacci on Google, and basically, we've probably all seen this pattern somewhere. Basically, this guy named something Fibonacci, he was an Italian mathematician. I'm not going to go into the full story, but he decided to make a sequence of numbers, and it runs all throughout the universe. As we can see, this pattern is everywhere in the world, and seashells and the galaxies and pine cones and flowers in our hands and basically everything. So Fibonacci is basically Donald Trump's hair. It's basically in everything in this universe. So if that's true, why can it not be in these markets? And sure, that may be true. And so what a lot of traders will do is that they'll find an impulsive push or a move in the market in one direction, and it needs to retrace to these certain levels, because these levels right here are basically just one Fibonacci divided by another, and that's how you get these. And that's just, how I've gotten those numbers. So basically, what will happen is traders will find that impulsive push in one direction, and they're going to wait for a retracement to any of these numbers. And there's more numbers than these because all you're doing is taking one Fibonacci number and dividing it by another, and that's how you get these. So if you have traded Fibonacci, you're very familiar with these. If not, here you go. But you won't be needing these numbers because you don't need to be using Fibonacci. Spoiler alert. So one reason that I don't like using fibs is because I'll just give you guys this one good example, and I want to keep these videos short and sweet, and you can back test these theories later in the future. I'm not here to make a 4-hour lecture on why you should or shouldn't. I just want to give you an example, food for thought, and then you guys can do your own research if you want to continue to or not use these. So what we have here is an example where the market goes up, and now as traders, we are waiting for the market to retrace to a certain spot. And typically, if it hits one of these numbers, these are our magical numbers. If price respects it and it's in confluence with other spots in the market, it's golden. So for example, what we are looking at is the market goes up to this high point. Now we're waiting for the market to respect one of these lines, and it does right here, right? We got a long wick, doji, another doji, another doji, another doji. So this is where the market is respecting. And if we look to our left, we've got the market respecting as well, because if you haven't seen part 3, it talks about support and resistance. Now we've got confluence, right? We had a floor, market breaks through that floor, and it now is treating it as a floor again. And it's in confluence with our 50%. So market has traced 50%. It's respecting this floor, which we know has respected before. So what we're going to do is we're going to buy this market, and we're going to ride it to the moon. Well, say we buy here. Where's our stop loss? Under here? Is it under here? Is it under here? We never really know, and we don't really know what our risk to reward is, because if we're buying at a 50% level, basically our risk will be under the low and then usually above the high. And that really only gives you a 1-to-1, which is not a good risk to reward, because basically in order to be profitable, you need to understand how these markets work more than 50% of the time, which is pretty difficult, especially if you're using the wrong strategies in these markets. And that's why a lot of traders won't be successful. So obviously the 50% doesn't work for us, so it keeps dropping. And then it respects our 78.6. Perfect. I was wrong about my 50%. This is where I'm going to get into the market. Look how it's respecting. We're going to now buy here. My stop loss is beneath the low. My risk to reward is even better, because look at this. This is amazing, right? my risk to reward is now a 3 to 1, basically 3.22 to 1. This is a lot better. I like this. And as we can see, obviously in the future we get stopped out. But one, this is definitely a better risk to reward ratio. I would never go with anything below a 2 to 1 because you want to try to give yourself the most advantage in this market, because it's an insane market and you don't want to be fighting the market. You want to give yourself the best advantage. So I recommend nothing. I never use anything below a 2 to 1. Again, I'm not a financial advisor, so take this with a grain of salt. Do your own research. But let's say we're a trader. The 50% didn't work for us. Okay, what the hell? 78.6 doesn't work again. You're like, well, fuck, what am I supposed to do? Right? We finally get to our last barrier, the 88.6, right? This is the last stand. Market's treating it so well. Look, market has been here for hours and hours and hours. So we find a bunch of our candlestick patterns like an engulfing pattern, or we can find things like I said, the engulfing, or dojis, or wicks to the bottom, or momentum shifts, or whatever we want to look for in order to convince ourselves that this market's going to go up. Retail traders are looking at this and they're placing their risk to rewards. They want to see how good, and it's like, oh my gosh, it's almost a 6 to 1. This is a perfect trade. I'll take this every single day. And what ends up happening is it just doesn't work. I mean, look, the market continues to fall, and that's because instead of using fib retracements and thinking these numbers are magical because you find them all in the market and they're just everywhere and they need to respond to you and blah, 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 all this crazy stuff. You just have to realize as a Forex trader, it just does not work like that, right? So that's my video on why I don't think you should be using Fibonacci. And again, another thing is it's just too subjective, which is basically the problem with all of 8 of these tools. You can basically use Fibonacci anywhere, right? You may use it from here to here, but maybe you may think it's this candle, or maybe you think it's this candle, or maybe you think it's the body of it and not the wick, or maybe it's just here. And so there are way too many ideas that you can play with, and when you're guessing in these markets, you're gambling. And the point is not to gamble in these markets, because you don't want to gamble with your money. If so, just go to a casino. It's a lot more fun than staring at a blank chart all day and losing your money repeatedly. So yeah, that's just my take on this one. Wanted to keep it short and sweet. But if you don't believe me, do your research, do your back testing. Using Fibonacci solely is not the way to go, and it's not going to help you become a profitable trader. I'll see you guys in part 6.